here in person, those who are hybrid, and to all of our testifiers as well for this hybrid tax meeting. Today, members, we're going to discuss the most recent tax expenditure report. And just to give you a little background, we've had tax expenditures for a long time. This report is mandated. But what is a bit new this year is we also, one of our provisions in the tax bill that was signed into law last year was the Tax Expenditure Review Commission. And so this, and I want to say, this was an initiative of Senator Box. And we are glad that we got this through in the final days of the session. And so today, I just want members to know that as we look at this tax expenditure report, we will be having additional, we will be able to use this tool, I think, even more effectively going forward. So our presentation today is on that mandated tax expenditure report. And we have the Minnesota Department of Revenue, Eric Willett. Welcome to the committee. He's the Tax Research Director for the Minnesota Department of Revenue. Mr. Willett, if you could, welcome to the committee, and if you could identify yourself for the record in the tape, please, and then continue.
Thank you, Madam Chair and members of the committee. My name is Eric Willett. I am the Tax Research Director at the Minnesota Department of Revenue. And I am pleased to present the tax expenditure budget. I will be sharing my screen and showing some slides. Okay, let's see. All right, looks like that's working. Can you see the slides?
Yes.
Great. The tax expenditure budget is mandated by statute, as you mentioned, Madam Chair. And I'll be going through just a few highlights of the report and some of the underlying theory that led to the report. And then I also will be talking about the changes that you referenced that are coming up. So this is our 18th tax expenditure budget required by Minnesota statute. It's due February 1st of even numbered years, although that is changing with the law changes enacted last year. It is a major project. It includes estimates for over 300 separate tax expenditures across 15 taxes. And 17 analysts have been working off and on this report since last summer. The project was led by Randy Sanford, Curtis Walker, Alex Hevern, and Nick Green. As I mentioned, this is the 18th one. The first one was in 1985, and there's a picture of the cover of the first tax expenditure budget. And our longest tenured tax researcher, Doug DeGroat, actually worked on the first tax expenditure budget. So a lot of people with a lot of tax knowledge contributed to this endeavor. So quickly, my outline for today is to talk about how we define a tax expenditure for the purposes of the tax expenditure budget, how to use the tax expenditure budget, or some things to think about as you're looking at the information in there, some information on the scope of tax expenditures in the tax code, and I'll zoom in on our 4 biggest taxes when I do that. And then at the end, I will talk about the new Tax Expenditure Review Commission, the changes to this report, and looking ahead for how that information will help you in the future. So tax expenditures are statutory provisions which reduce the amount of revenue that otherwise would be generated by granting a special selective tax relief to a subset of taxpayers. Or alternatively, it's a provision that reduces the tax base, thereby preventing us from having lower tax rates to raise the same amount of revenue. So if the only goal of our tax system were to raise revenues, then most economists would say it'd be best to have a broad tax base with as low of rates as possible to minimize economic distortions, meaning not changing people's behavior to avoid taxes. But that is not the only thing we ask the tax code to do. And just thinking about the income tax, state policymakers have an interest in a variety of outcomes, and they use the tax code to try to achieve those. Because we want to encourage home ownership, we have the mortgage interest deduction. To help pay for childcare, we have the childcare credit. To recognize and reward combat veterans, we have the combat credit. To increase business startups in the state, we have the angel investment credit. To assist beginning farmers acquire land or other assets, we have the beginning farmer credit. So each of these outcomes could be advanced through direct expenditure programs to meet the same goals, and some actually do have direct expenditure programs that are trying to achieve the same goals. But there are tax provisions that attempt to incentivize behavior or reward behavior that the legislature and the governor deem as good public policy.
Yes.
For the purposes of our report, I encourage you to read the introduction if you haven't yet. A lot of what I'm going to be talking about is in the introduction, but it's really important to know how we define a tax expenditure for the purposes of the report. We only put a tax expenditure in the report if the tax that is an exception to applies statewide. So we don't do anything with tax expenditures for special local taxes. It provides preferential treatment. So as I mentioned earlier, some taxpayers get a break compared to similarly situated other taxpayers. It has a revenue impact, so someone's paying lower taxes or everyone's paying a higher rate because of the provision. It's not subject to an alternative tax. There are some exemptions, such as how we don't have the general sales tax apply to cigarettes, but there is a separate excise tax on cigarettes that's sort of in lieu of sales tax. So we don't count the sales tax, general sales tax exemption as a tax expenditure because there's another tax taxing that activity. It's not counted as a direct expenditure. There are some things within your purview as a committee that you do that are tracked as state spending expenditures, such as local aids to local governments, property tax refunds, those sorts of things. We don't count those as tax expenditures because they're part of the regular state budgeting process. A tax expenditure has to be under the authority of this legislature to statutorily change it for us to put it in the tax expenditure budget. Property tax exemptions that are exemptions because of the state constitution, we don't include in this report because the legislature and governor don't have the power to eliminate that tax expenditure on their own. Also, some federal law dictates some things that we don't count as tax expenditures in this report because the legislature can't change them. And finally, it's included in the definition of the tax base. And I want to talk a little bit about that because it's really important in the introduction to each of the chapters on specific tax
Mr.
types.
Willett,
Yes.
Mr. Willett, I do want to give members a chance to ask questions before you get too far into that presentation. And so I'd like to call on Senator Weber.
Thank you, Madam Chair. Mr. Willett, in the previous screen, tax expenditure as a concept, you mentioned the different credits that are allowed to encourage certain behavior. In the process here of putting together this report, do you ever look at whether or not if we had reduced tax rates, lower tax rates on the citizenry, as to whether or not all these credits would actually be necessary, and would they be as successful or anything like that?
Mr. Willett?
Madam Chair and Senator Weber, thank you for that question. The evaluation of the effectiveness of the tax expenditures really is beyond the scope of this study, which is one of the things that led to the passage last year of Senator Bach's and Representative Marquardt's idea of this tax expenditure review commission. And I'll talk about that a little bit more at the end, but I think trying to evaluate whether these public policy choices are advancing the goal that they're trying to advance is something that group is going to try and grapple with. And that is frankly a much more difficult question than what this report does, which is it catalogs the exemptions that exist and exclusions and other tax preferences so that you as a committee and the legislature as a whole are aware of the policy priorities and the money that's being moved around or taxes foregone or rates being increased because of the existence of these. So I think your question is a very important one, and I think that's the fact that this report hasn't had that as part of its scope is one of the main reasons for the law change last year, to allow for a little bit more in-depth analysis of, so what do these get us besides reducing taxes by this many dollars to these taxpayers?
Very good. Thank you.
Thank you, Senator Weber. Mr. Willett, continue. And members, just to note, if you have a question on a particular slide, we'll try and address that before the presentation advances to the next slide. So just raise your hand. Mr. Willett.
Thank you, Madam Chair. So to know what a tax expenditure is, we have to know what the reference tax base is, because it's not a tax expenditure if unless someone is, some taxpayers are getting a preferential treatment compared to others. So the reference tax base is defined at the beginning of each chapter for each tax. And as we define them, that doesn't mean we're promoting these as the ideal tax base. We're not saying that this is what the tax base should be, but it is a definition that tries to identify a way for all taxpayers to be treated equally, and to have minimum economic distortions. So for example, income taxes, we define the tax bases as very broadly income from all sources less the expenses that are reasonable and necessary to generate that income. And that's kind of a economics textbook definition of an income tax base. So if something is an expense necessary for the production of that income, such as assets that depreciate, regular depreciation is not considered a tax expenditure. Our special provisions that allow for depreciation beyond regular book depreciation are considered tax expenditure. So bonus depreciation and those sorts of provisions, because they allow some taxpayers who qualify for it to have accelerated depreciation, that difference is considered a tax expenditure. We consider the rate structure and the standard deduction to be part of the base tax, because it treats everyone uniformly, but deviations from that through credits, exemptions, exclusions, subtractions would be tax expenditures. For the corporate tax, we again use the broadest measure of income possible, and we also assume that the reference tax base has equal weighted apportionment. So our single sales factor apportionment is considered a tax expenditure because it advantages some corporations differently than others, as opposed to a 33% each equal weight apportionment. And for the sales tax base, the reference tax base includes all final purchases of tangible goods or services. So business purchases of capital are in the tax base, while taxing those may not necessarily be good tax policy. For the purposes of identifying what's outside of the regular tax base, we do account that as a tax expenditure. It's important to note that tax expenditures differ from regular expenditures that are authorized by the finance committees in a lot of important ways. And a lot of these things are reasons why the legislation passed last year. Tax expenditures don't have a line in the biennial budget, so there's less biennial regular scrutiny of tax expenditures. For the most part, they don't have a regular review process until now, and I'll be talking about that at the end. Most of them have no limit on growth over time or sunsets or anything. Most direct spending has to be reauthorized every 2 years by the legislature. There is some ongoing standing appropriations, but by and large, most of the direct expenditures are not on autopilot. They have to be authorized by budget bills every 2 years, whereas tax expenditures go on in perpetuity unless the legislature chooses to change them. They're authorized by the tax committees rather than the spending committees. So there's a different legislative process for tax expenditures. And they often have more limited access to information about who's benefiting from them, because most tax data in our major tax types is non-public data. there's less public information available as to who's benefiting from tax expenditures as compared to some of our direct government spending programs. And finally, there's an important difference of perspective. If I want to advance a particular policy goal and I have a choice of promoting a new program for spending state dollars or creating a tax expenditure to incentivize behavior, one of them will increase government spending overall. The other one will decrease taxes. So it will look like it's decreasing the overall spending of government. While that may not be, sort of an important distinction in reality, it is important how people perceive a new program. So it's important to keep that in mind. So this is just a list by chapter of the number of tax expenditures. Most of the tax expenditures are in individual income tax and sales tax, 100 in each. So 2/3 of all the tax expenditures we've identified are in those two tax types. If you'll pay attention over the course of a legislative session, a lot of your business will be centered around those two taxes. So a lot of proposals often are focused on those two tax types. This slide just is a snapshot of what one of these looks like. If you open up the report, this is the home mortgage interest, which is on page 63. It's item 1.66. So from top to bottom, all the tax expenditures will follow this pattern of having a title and a number, then a legal citation where in statute this expenditure is authorized. It'll have a description of what the current law, what the tax expenditure is. Then it'll have a brief history of how this expenditure may have changed over time, an estimate of the number of taxpayers who are affected by it, and then at the bottom, an estimate of the dollar impact if this tax expenditure were repealed. How much would this tax increase on the currently benefiting taxpayers? So in the case of mortgage interest deduction, if you were to repeal this, which because this is a federal provision, it would mean adding an add back on the Minnesota form. Minnesotans' income taxes would increase by approximately $80 million. I always give these sort of caveat warnings when I do this presentation. When using the tax expenditure budget, I encourage you to remember 3 cautions. The first one is that repealing some tax expenditures would increase complexity rather than simplify the tax code, specifically thinking about federal conformity issues. If we were to repeal these tax expenditures, it would require taxpayers to add back a benefit from their federal taxes onto their state tax. So it would actually make filling out taxes harder on people. Some other tax expenditures would simplify the forms because you wouldn't have to you'd be removing an extra step that taxpayers take. But in the case of federal conformity, you'd actually be increasing complexity for the taxpayers by eliminating these tax expenditures. And there's other examples beyond federal conformity where the existence of some tax expenditures actually simplifies the tax system. Secondly, repealing some tax expenditures would cause compliance challenges. There are some tax expenditures where there isn't really ready data for taxpayers or the department to use to administer these taxes. Thinking of some non-taxable benefits that some workers get there isn't data collected on them federally or by employers and reported to the department. So we'd have to create more of a sort of data infrastructure for some of these tax expenditures. Another one would be the sales tax on occasional sales, which basically is your casual sales that people periodically do, like a garage sale or that sort of thing. Those are exempted from the sales tax. Trying to tax them would be administratively complex for both the taxpayer and the department. So that's a tax expenditure that there probably isn't a big audience for recommending repealing that tax expenditure. The third caution is that tax expenditures interact with each other. So if you're thinking about potentially repealing a number of tax expenditures, adding up the numbers in the book isn't necessarily the right answer. That's where a revenue estimate from us can come in handy. So they often interact with each other. So simply adding them together would give you a false picture. One example of that is itemized deductions. Eliminating one itemized deduction, we show what the impact of that would be in the tax expenditure budget. But if you eliminate a second one, you're not going to get the full dollar amount that's in the report, because as more taxpayers switch from itemizing to standard deduction, the repeal of an additional itemized deduction wouldn't have any more impact on them, because they've already switched to the standard deduction. So if you simply add up the itemized deductions in the report, it's $260 million, but there's actually almost $90 million of interaction. So if we were to repeal itemized deductions altogether, the net impact would actually only be $170 million. So that's how that's one where the interactions are pretty significant. So again, the message here is, if you're thinking about making changes and eliminating multiple tax expenditures, either to increase taxes or to allow for a rate reduction, you want to be sure to request a model run so we can make sure that we identify any interactions between the policy changes.
Yes, Senator Rust.
Thank you. Thank you, Madam Chair. I wonder, and I keep looking at the witness table, expecting you to appear there instead of on the screen. But Mr. Willett, I wonder how helpful it might be, even though it's not an accurate accounting if someone had a bill that got rid of either increased or got rid of a tax expenditure. If it still wouldn't be, and the revenue estimates are more accurate, I wonder if it still wouldn't be useful information to us if the number from the tax expenditure budget wasn't presented at some point as a footnote, for example, on a revenue estimate. I think some of us would find that very interesting information, just to get into our mindset what the magnitude of the proposal is that we are discussing at any given time. Just a thought. I mean, it only takes just bringing it out of the tax expenditure budget and putting it in the revenue estimate with the caveats that you have already presented.
Mr. Willett, do you have any
Just a
comments?
suggestion.
Do you have any comments on that suggestion?
Madam Chair, Senator Rest, yeah, thank you for that suggestion. I think that is a useful piece of reference information. Specifically, I'm thinking of times when the bill proposes phasing in or phasing out a tax expenditure. And in those cases, sometimes we do try to, in the footnotes or in the revenue estimate details, identify what the sort of fully phased in cost or revenue increase is from a proposal. And I think that is one of the important things you do get from the tax expenditure report, is sort of the whole cost or the whole revenue increase from a full repeal. So I think we'll take that into consideration, and I think it's especially useful if the proposal is to phase something in over time, where within the forecast window, you're not really seeing the full impact of what the proposal is.
Thank you, Mr. Willett. Just kind of a bit along the lines of your last couple slides here. The ideas regarding caution, if in fact repealing a tax expenditure would put us out of federal conformity, and what that would do to taxpayers and preparers, and also then the those tax expenditures that it would be hard to have compliance if we remove those tax expenditures. And as I look at the report, and thank you, it is a large undertaking. And as I look at all of those 300 and some tax expenditures, I don't know if they're identified in that way. It would be helpful to know which of those tax expenditures have some link to federal conformity. And also which of those tax expenditures have a complexity issue that would make it difficult for repeal. So I'm wondering at some point if the report or just an updated follow-up could somehow rather easily, I don't expect anyone to redo the full report, but I think it'd be important to identify which ones have federal conformity ties and which ones have complexity concerns.
Thank you, Madam Chair. And I think we try to mention in the narrative of the report, the ones that start with that deviate from a federal definition or start with a federal definition. But the complexity, we do that sort of off, outside of the report. We try to list those, and we could certainly put together a list. It is a little bit subjective, and I think if you ask different people in different parts of the department, you might get different opinions about which ones would create an onerous amount of complexity versus maybe just sort of a minor hassle for taxpayers. But we can certainly share our opinions on that. That is one of the things that I think the fiscal note and the testimony bring out when a proposal comes forward is what sorts of problems will this create? And sometimes the taxpayers and their representatives will identify administrative challenges that we wouldn't think of. So it's important that we, that you hear from them as well. The CPAs and the others who are coming at it from the taxpayer's perspective.
Oh, thank you, Mr. Willett. Those are good points. Although we don't have hearings on every single tax expenditure in the report. So I do appreciate you pulling together that. And I understand, we all would understand it's subjective. One person's simple task is another person's gargantuan task. So we understand that. But yes, that would be helpful. And then I see Senator Rest has her hand up. Senator Rest.
See him, there I am. I had a follow-up question, Mr. Willett, about our of interest to me. I'd asked if you could at some point just include the tax expenditure consideration or the page, or even just directing people to the page in the tax expenditure budget, because it seems to me that one of the reasons for the Tax Expenditure Commission was to get legislators very familiar with that document, and that it not just be something that was put on the shelf, but that you would say, well, with a bill, this tax expenditure is explained on page 169, or meaning that we'd have to look it up. And I think that's a good exercise for legislators who sometimes expect information just to be handed to them on a plate. And then in addition, the comments that you made earlier about for some policy changes, there is no appropriate tax expenditure to report. And even that information, I think, should be something that we become far more familiar with than we currently are. I think most of us do, if we have a big bill that gives tax relief, let's say changing the sales tax rate or something, that we truly do understand what that impact is. And also your second line in this slide that adjusts for the interactions in elsewhere than just the straightforward explanation of the tax cut that would generally be part of the discussion of the bill that's being presented, but for the department to guide us more, even by reference to the tax expenditure budget when we have bills in front of us, I really think that would be very helpful to legislators. It would be helpful on the floor of the Senate when we're discussing the omnibus bill or any other major bill. And it certainly, I think, would be of use to in how we communicate with our constituents about what a proposal actually means. So I really enthusiastically encourage you to consider, I mean, don't create a whole department for it, but to give us that information. I'm just going to assume everybody at this table would benefit from it. Thank you. Thank you, Mr. Willett. Thank you, Madam Chair.
Thank you, Senator Rust. Mr. Willett, either comments or on to the rest of the presentation.
Thank you, Madam Chair. We'll always look for additional ways to provide helpful information to you. So I appreciate those comments. This slide just kind of highlights how a revenue estimate that we prepare for a specific bill that has a hearing differs from a tax expenditure item. So the tax expenditure budget, as I said, doesn't, it ignores interactions among provisions, whereas a revenue estimate will take that into account if a proposal proposes to change more than one part of law. It ignores any interactions or impacts on other taxes, whereas a revenue estimate will note that a change in property taxes will have an impact on itemized deductions, for example. The tax expenditure budget doesn't take into account effective dates, whereas a revenue estimate will be very specific about there's an effective date beyond which the law changes, and that guides what the impact is. The tax expenditure budget doesn't generally take collectability into account, whereas a revenue estimate will make comments in that regard. And they're updated only every 2 years. This report is only done every 2 years, whereas a revenue estimate will be based on the most current economic forecast from MMD. Okay, I want to talk just real briefly about the four biggest taxes, state and local taxes that we have, and the scope of tax expenditures within those, starting with the individual income tax. So what this chart shows is if our reference tax base was the tax base, then the gross revenue raised by the income tax would be in the magnitude of $21.1 billion. That's not a perfect number because we aren't able to isolate all the potential interactions involved with that, but the ones that we could isolate, we took into account. So the gross revenue is the term that we use, which would be if you stripped out all the tax expenditures, then the income tax could raise $21 billion. And here's where we did that exercise that Chair Nelson was referring to, where we split the expenditures into those that have a lot of administrative challenges with repeal versus those that would be pretty straightforward to taxpayers and the department. And as you can see, for the income tax, the bulk of the tax expenditures are ones that would have administrative barriers to repeal. That's again why I said the reference tax base isn't the ideal tax base, it's just the reference tax base. But when you take all those tax expenditures out, then the net revenue of the income tax is about $12.5 billion. I forget which year this represents, but I think it's tax year 21 or 22. And then on the right-hand side of the slide, we're showing if you did repeal all those expenditures that cause few or no administrative problems at $1.4 billion, this shows you what the rate structure could be if you were to reduce all the rates by eliminating those tax expenditures, which would in effect be shifting taxes from the people who don't benefit from those tax expenditures onto the people who currently do benefit from the tax expenditures. And as you can see, the rates go down by about, what is that, about 6 or 0.7%.
Thank you, Mr. Willett. Before you move on, Senator Klein, you have a question.
Thank you, Madam Chair. And under the tax expenditures with significant administrative barriers to repeal, is the bulk of that federal conformity, or are there other significant administrative barriers in that group?
Mr. Willett?
I think the bulk of them are tied to the federal code. I'm just looking at which ones I have jotted down. Yep. I can put some information together about which ones fall into that category and which are the largest ones that fall into that category. I don't have it at my fingertips. But federal conformity is a big issue because it really would increase complexity to have basically a Minnesota system that has as many provisions as the federal system. Whereas now, when you get to the Minnesota return, you're sort of on the downslope, the easier side of doing your taxes. But if we eliminated all the conformity with the federal system, then we'd basically be having our own full tax system.
Any further comments, Senator Klein? Thank you. Mr. Willett, continue, please.
So I just wanted to note on the itemized deductions, this is comparing where the itemized deductions were in the 2018 tax expenditure budget based on tax year 2017 and today. You may remember when you all decided how to conform and react to the Tax Cuts and Jobs Act. A couple of the big provisions in that were to limit the state and local tax itemized deduction and to double the size of the standard deduction. Both of those provisions made it less likely for people to be itemizers. And you can see on this chart how many fewer people today or how many filers are, how many fewer are taking advantage of the various itemized deductions and the smaller dollar amounts, which are down by, a lot of them are down by the 50 to 70% range. And conversely, the charitable contribution subtraction for non-itemizers has gone up because with fewer people itemizing, more people who are still making charitable deductions are taking advantage of that provision in law. The overall number of itemizers has been reduced from something like 35% down to something like 6 or 7%. So a very significant change to how people are using the tax system because of those two major policy changes. It started with the federal Tax Cuts and Jobs Act, but were mirrored in Minnesota law in 2019. Here's a chart similar to the income tax fund for the corporate franchise tax. Again, the gross revenues is about half again as large as the net revenue. The tax expenditures with significant administrative barriers is smaller than with the personal income tax. If you were to repeal the tax expenditures that we judged don't have significant administrative problems, the corporate tax rate could drop from 9.8% to 7.05%. The sales tax has a lot of tax expenditures, partly because we exempt so many business purchases, business inputs, which is good tax policy, but still counts as a tax expenditure. Here we're showing the tax expenditures by purchaser. So gross revenue of 14.6 billion, tax expenditures of 4.6 billion for government, nonprofit, and business purchases, tax expenditures by consumers that are exempt of 3.4 billion for net revenue of $6.5 billion. Repealing just the consumer purchases would allow a rate reduction to under 5%.
Mr. Willett, I would just say, can you back up on that slide a minute? It's just rather telling to me that there are more sales tax expenditures from government, nonprofit, and business combined, I guess. Be interesting to see how much just the government and the nonprofits
The-
piece of that is.
Yes, Madam Chair, and they are separated in the report, and the business purchases is the bulk of that number.
Yes, that's what one would expect. All right,
Yep.
thank you. Senator Rest.
Thank you, Madam Chair, and Mr. Willett. Going back to the corporate franchise tax expenditures, on the line where it says other tax expenditures, assuming that those are ones that cause few or no administrative problems, could you name one significant one that would fall into that category? One or two?
Mr.
Um,
Willett.
I can, unfortunately, the way my screen is showing, I can't see my speaker notes, so give me just a moment. Just turning to the large table at the front of the report. Well, such as, going back to uniform apportionment, it would cause some administrative challenge because corporations would have to report sales and property again, like they did prior to going to single sales apportionment. But I believe that we consider that to be a low administrative burden. Let's see, some of the timing provisions, there would be an adjustment period. Well, no, those I think would, I'm sorry, those would fall into the complexity. Let's see, like some of the credits, repealing credits would actually technically simplify because I wouldn't have to fill out the lines for applying for the credits, although it would increase the tax burden. Other exclusions where they're adding back numbers on the tax form. Again, those increase burdens by elimination, but they decrease the steps that a taxpayer has to take to fill out the forms.
Madam Chair, Mr.
Senator
Willett, I
Rest.
think that's another piece of information that would be helpful to members as they propose bills for the department to say, if the change that's proposed in this particular piece of legislation were passed, it would, there would be an insignificant or a significant administrative burden. And I know one of the items on every omnibus bill, Madam Chair and Mr. Willett, the department always proposes what it will cost to administer the bill that we pass. And we sometimes ignore that and just say, eat the cost. Other times we meet the department's requests, and sometimes we don't analyze it. We just pick a number that we feel like we can afford. So I think doing at the front end might again be of interest to us. The other question I have is on sales tax expenditures, and that gray bar of tax expenditures by consumers. Is that primarily food and clothing?
Mr. Willett.
Madam Chair, Senator Rest, food and clothing are the two biggest ones. Also some medical expenses and things like that is another very large one. Yeah, I think those three probably account for at least a third, if not half of that total. But again, if you look at the big table at the front, the sales tax table at the front, you can, the really big ones jump out because they're so big on the numbers.
Thank you, Madam Chair and Mr. Willett.
Thank you, Senator Rest. Mr. Willett, to the.
Thank you, Madam Chair. And I appreciate the point about highlighting complexity. And I know that when our administrative staff and Joanna Bears and people from the divisions provide information to you, they often are talking about the potential complexity to the department for these provisions. I think what sometimes gets conveyed, but maybe sometimes doesn't, is the potential complexity to taxpayers, either making it easier or harder. But that is, something that is also a very important piece of the consideration when you're considering a tax change. So we'll do what we can to make sure that that's reflected as well. I've got just a few more slides. The, uh, this is a shrinking of a table that's on pages 117 and 118. And this shows selective sales tax services, business services, and consumer services that are exempt. This isn't all the services. So this is a partial list. We haven't cataloged all of them. But as you can see, there are some really large ones, and this is the bulk of the business purchases that are exempt. And a lot of consumer services as well. Some of these would be administratively complex to repeal, but most of them could be done. I want to just real briefly talk about the property tax because this is the one chapter that's quite different from all the others in the report because of the nature of how the property tax works. Unlike other taxes, the property tax doesn't have fixed rates. It has a fixed base, and then local governments set a levy that is spread against that base. Because of that, because of the nature of that tax, the way we characterize tax expenditures for the purposes of property tax is by showing the shift that would happen holding levies the same, how taxes would shift from one type of property onto other types of property. So if the benefiting property, if their special provision were repealed, how much would their taxes go up, which would then translate as tax relief to all the other properties within the same jurisdictions that property, where that property is situated. So it's shifts, not change in taxes in this chapter. The largest tax expenditure is the classification system and exemptions. The report doesn't include exemptions for property that's exempt because of federal law or the state constitution. So if you look at the exemptions list, it doesn't include, for example, schools and churches because it takes more than a statute change to apply the property tax to those types of property. So this is a variation on what you can see on pages 190 to 191, which shows the dollar shift of eliminating the classification system and having all levies, including the state general levy, spread by market value on all property. But this table on the PowerPoint shows the percent change rather than the dollar change, because the dollars can be a little bit abstract. And I think the thing that this chart shows is, relatively speaking, which classifications of property benefit from the classification system and which ones are disadvantaged by the classification system. By that definition, the properties that have the largest percent increase from repealing the classification system are the ones that are most advantaged by the existence of it. So when you see the large percent increases in farm homestead land and timberland and farm non-homestead land, residential homesteads, those are the classes of property that benefit the most from the current classification system. Whereas the big negatives, the commercial property, the utility property, the railroads, personal property, those are the properties that are most disadvantaged by the classification system. Okay, to wrap up, I just want to talk a little bit about changes that are coming. As the chair mentioned, last year you all enacted, created a new tax expenditure review commission. So this is a commission under the Legislative Coordinating Commission with staff out of the Legislative Budget Office that has a membership of 8 legislators, 4 senators, 4 representatives, and the Commissioner of Revenue. And its responsibilities really stem from a report that was put together about 10 years ago. A group of economists were brought together under a law that you passed to review how we look at tax expenditures and make recommendations for improvements. And a lot of what you did last year has echoes in that report. So this group will first and foremost define what the objectives of tax expenditures are. You know, Minnesota has a long history of trying to avoid putting purpose statements into statute. That's not always true, but generally as a practice. Because of that, there aren't real clear definitions of what the goal is or what the intention was when a tax expenditure was enacted. So if you're gonna evaluate something, you need to know what it's trying to achieve. So the first task of the Tax Expenditure Review Commission is to assign objectives, goals to the existing tax expenditures. Once those are established, then the commission will, on a rotating basis, do evaluations of the tax expenditures. There's some criteria in the statute that determine which ones should be reviewed. But generally speaking, all the significant ones should be reviewed over time on a rotating basis. And that review should include an evaluation of the effectiveness the tax expenditure has in achieving its purpose. So we know from the work that we do that the mortgage interest deduction reduces homeowners' income taxes by $80 million. What we don't know is, did the existence of that enable how many more people to buy a home who wouldn't, or did it encourage people to buy larger homes than they otherwise would? Did it not change behavior at all other than reducing income taxes? That's the evaluative part that this group is going to wrestle with. It's also going to compare the tax expenditure to similar spending programs. So we have the mortgage interest deduction. We also have home ownership programs run from the housing finance and other government activity that attempts to encourage home ownership. So the review commission is going to look at these collectively and say, well, is one better than the other? Are they actually achieving different ends? Should we be focusing on one approach rather than another? That sort of thing. And then finally, they have the authority to make recommendations for modification or repeal back to you all. After doing this evaluation, we recommend doubling the size of this one, eliminating this one, changing the parameters of this one so we'll better achieve its goals. Those are the three main components of the review that they're going to do and then report back to you for possible action. We have a role in this. The law change also tasked us with some additional new responsibilities to help support the commission. The bulk of the staffing will be staff of their own through the Legislative Budget Office, but we will be providing data analysis from the tax data that we have access to assist with that, including incidence analyses for significant income and sales tax expenditures. So who are the beneficiaries by income range is one of the pieces of information that we'll be providing to the Legislative Budget Office as part of their evaluation. We know that since I've been talking about the mortgage interest deduction, itemizers have always tended to be on the higher end of the income scale. That's even more so now that it's gone from 37% of taxpayers to 7% of taxpayers. So an incidence analysis of the mortgage interest deduction would tend towards the higher income ranges. And that will be part of the evaluation that the Tax Expenditure Review Commission will do. And it's also something that we're tasked with putting into the next version of the tax expenditure budget. So for those tax expenditures that we will be doing an incidence analysis of, we'll also be putting those analyses in the report. So they'll be right there for you to see.
Mr. Willett, just one comment or question as you move forward with that next task. I would assume that they're going to be broken into pieces so that each year you're not required to do all of those, or is the review commission actually going to tackle all 300 of them in 1 year? Seems like it would make more sense to have a rotating every, I don't know, 2 years, 4 years, rotating through, or 5 years. I just wanted to get some sort of sense on the timing of that task. It's a big task.
Madam Chair, yes, my understanding is that it will be a rotating basis over a number of years. And given the number, the statute allows for setting aside some tax expenditures for not reviewing some of the smaller ones, some of the federal conformity ones, where it's actually, they can review them, but they're not required to. So the list of those that they're required to get through, I haven't counted up, but it's much less than the 300 that are in the budget. But even so, they'll need many years to rotate through if they're going to do a thorough review of all of them. And that'll be up to the commission, to figure out the fewer we do, the more detail we can get into, perhaps the higher value the reviews will have. So that'll be something they'll have to wrestle with.
Thank you, Mr. Willett. Senator Klein.
Thank you, Madam Chair. Mr. Willett, can you refresh my memory and remind me, how will the report of the commission be presented to the tax committee, and when will it be sort of a printed format? Will we have a hearing regarding it, and when should we expect that thing?
Mr. Willett.
Madam Chair and Senator Klein, I'm calling up the language right now. There is a formal reporting requirement. Let's see. Reports alleged December 15th of each year, the commission will submit a written report to the committees with jurisdiction over tax policy.
Thank you, Mr. Willett. Senator Klein, anything further? All right, thank you. Senator Rest.
Thank you. Thank you, Madam Chair. Mr. Willett or Madam Chair, who are the members, legislative members of the Tax Expenditure Commission? If you would refresh my memory on that.
I'll let Mr. Willett take that. I don't know that they've been appointed yet. Mr. Willett.
Madam Chair, I'm afraid I also do not know if they have been appointed yet. I do know that the LBO is still hiring the staff. So I would say that this is kind of in process right now.
Thank you. Any further questions? Senator Rest? Nope. All right. Members, we've come to the end, I believe, of our presentation today. Mr. Willett, as always, thank you for the excellent information. We do have a lot to look forward to. I do think this will be incredibly helpful. And I wanted to give you a moment if you had any final comments.
Thank you for your time. Again, if you do have any questions on the specifics in the report, please reach out. We love to talk about our research. Just remember that what's in there is different than what will be in a revenue estimate. So if you're getting serious about a particular idea, reach out to us for information that will be more like a revenue estimate.
Thank you, Mr. Willett. Members, that brings us to the end of our hearing today, a very good informational hearing that I think will help us make better decisions as we move forward. Our next meeting will be Thursday, February 17th. This meeting is adjourned. Thank you, members.